What's up, guys? Welcome back to another YouTube video. If you don't know who I am, my name is Jacob. I'm an 18-year-old swing trader. I've been trading for a little over 3 years now. Been profitable for a little over 2.5, coming up on 3 years now. But I've been able to make over 15K a month pretty consistently, hitting 6 figures at 18 through swing trading breakouts to be exact. And in this video, I'm going to show you guys my exact setup, strategy, and my overall system on how exactly I do this and how you guys can do it for yourselves as well. So hopping right into things, I'm going to go ahead and grab this PDF and we can follow this. So first up on my process is going to be analyzing and gauging market conditions. So market conditions, starting off, the first step to swing trading breakouts is gauging market conditions. By gauging market conditions, we can identify bull or bear markets in order to discern whether or not the overall market is good to swing trade. So first up in my process, gauging market conditions, see if we're in a bull market, a bear market, if we're overall in a bullish trend, a bearish trend, if market's hot, is it cold, etc. So how do we identify market conditions? Number one is going to just be obviously market trends. So identify clear trends, look for established trends, upward, downward, uptrends, downtrends. On the daily or weekly charts, swing trading typically thrives in trending markets. Obviously, when we're swing trading breakouts, we're only looking for bull markets. Swing trading breakouts does not thrive in bear markets or pullbacks, anything like that. We want to look for, steady uptrends and the SMAs aligning, which will move us into the second part right here. So the moving averages, we want to use the 10, 20, and 50 SMA or EMA. Personally, I use the SMA, and we want them to align and stack on top of each other. This shows overall strength, and that market is typically going to trend higher. And then the third is going to be support and resistance levels. Identify key levels. So look for well-defined support and resistance levels on the charts. Swing traders often aim to enter positions near these levels, anticipating price reversals. This, not so much. We use support and resistance kind of like a confluence because again, we can't predict anything that happens in the market. If you're trying to predict, you will get burned. So what we want to do is kind of just mark out specific key levels, support and resistance, to give ourselves an educated guess of where market could possibly go. And then according to wherever it does go, play your cards right from there, or give yourself the red or green light if you should trade or not. And then number four, market sentiment. So analyze sentiment indicators, use tools like the Fear and Greed Index or sentiment surveys to gauge market sentiment. Favorable sentiment can support swing trading opportunities. News events, be aware of upcoming news that could impact market conditions, major economic. So basically just catalysts. So watch out for, earnings reports, big piece of news, info, anything like that that comes out unexpectedly. Just watch out for those things, or if they are expected, just, keep that in mind while you're swing trading. So now that we kind of covered this, we look for market trends, moving averages, support and resistance levels, and market sentiment. Let's go ahead and just bring this straight to the charts now. So you can use any sort of index, SPY, QQQ, COMQX, whatever you want. But personally, I just use SPY. So you're going to hop on SPY, you're going to have the daily chart, and you're going to have the 10, 20, and 50 SMA here. For me, the blue is the 10 SMA, purple is the 20, green is the 50 SMA. And we overall just want to see market trending higher. So, for a good period, let's just start back here last February. So last February, we can see pretty healthy, just, surfing the 10, above the 10 and 20-day moving averages. Looks pretty clean, trending higher. And then we can see big nasty day right here. 10 crosses below the 20 and below the 50. You would not be trading during this period. Breakouts are not going to sustain that much. And overall, this just isn't pretty. This isn't what we look for. And then we can see, market consolidates, breaks out of this kind of base right here, tries to, attempt to trend higher, and it does, it succeeds. And then we can see the SMAs realign. And as they start to realign, we would start to, put risk back on. You'll see more setups occur. Market will probably just look better overall. We can see as it's surfing the 10 and 20, just consistently moving higher and higher until we pull back again. And then this was also not recent anymore, but the market crash that happened, this was pretty nasty right here. And as you would expect, okay, pretty nasty dump, but then you would expect, okay, make it up right here. But the thing is, you don't want overbought volatility when it comes to swing trades. You don't want things to be overbought, excited. I'm trying to find a word. I would say probably like euphoric. You don't want to trade these euphoric periods either because they're also just a little too volatile and it is easy to get stopped. What you want, ideal, is literally just steady moving uptrends. You want steady moving uptrends, surfing the 10 and 20 SMA, and just grinding higher. That's what you want in terms of looking at SPY. But again, you can just kind of mark out these key levels like we talked about. Again here, double top right here, 1, kind of 2, 3, touches right here, again 4, and then finally breaks out. And then again, as you guys know, previous resistance becomes, prior support. Yeah, after a stock breaks out, it becomes support. And yeah, we can see it bounces again and then surfs the 10 and 20 nicely, gaps down, gaps back up. retest the 20, and then overall just surfing higher. So from here to here, pretty solid period, really smooth, and then a little bit of chop here. This was a pretty good period, nice smooth uptrend, surfing the 10 SMA. This was pretty hard to trade, really choppy period right here, not so good. And then, you know, pretty choppy lately, but overall hasn't been a super hard market to trade. We've been able to get some good trades out of here. And now we can see market is trying to take out all-time highs. We did have a pretty dry day today. It was pretty slow. What day is it today? It's February 20th. It's Thursday right now. Tomorrow is Friday. But yeah, February, not a whole lot going on. A lot of chop in February. Nothing crazy exciting, but overall hasn't been too bad. We'll see if we take out all-time highs like we did on Wednesday. And yeah, we move from there. But that is going to conclude kind of this first section. This is how you analyze market conditions. And again, take this with a grain of salt. This doesn't mean like, oh, you know, if market had one red day like today where it's kind of nasty, you have to sell everything and go crazy. No, it's not. Take it with a grain of salt. Just understand if market is in just an overall uptrend, you're good to trade and just you can move on into the next step. Okay, here we go. Step 2. So now we gauged market conditions. We found out market's good. What's our next step? What kind of stocks do we trade? How do we find those stocks, etc.? So we're going to go over the setup first, and then I'll show you guys the scanners I use to actually find those setups. Going over it, this is what we look for. So the setup. You want to find stocks that make a big move, pull back, and surf the 10 and 20-day moving averages. And you want to make sure the 10 and 20 are rising. That's going to be like completely ideal. You want the stock to make a big move and pull back to the rising 10 and 20-day moving average. And then you want to see it start to create higher lows and lower highs. And you want to see it start to create this flag pattern. And you want to see the coil kind of tighten up. So big move, pull back, tighter, tighter, tighter. I'll show you guys just a little bit of a quick drawing. So you want to see the stock make a big move and then it goes sideways. And during this sideways period, you want to see it pull back to the SMA. Oops, that was a bad line. You want to see it pull back to, let's say the 10 SMA is right here, 20 is down here. You want to see it pull back to the SMAs and then start to create these higher lows as we can see on the bottom and then the lower highs as we see on top. So it kind of creates this kind of flag pattern, this triangle that we look for. And we can see it almost looks like a coil. It made a big move, pulled back to the 10 SMA, the 20 SMA, and then it's creating those higher lows and those lower highs as well. And it's coming to a pinch. It's getting kind of tight. It looks like it's tightening up. It really wants to break out of this. This is essentially the setup that we look for in a nutshell. So we want it to tighten up, get super, super tight, really thin day, and then boom, breaks out, and then breaks out on really high volume. So continuing that, ADR. ADR is preferred to be above a 5%. This signifies that the stock is not a slow mover and doesn't keep your money tied down for an extended period of time just to make a small move. We want fast moving stocks, explosive moving stocks. You guys kind of get the idea. ADR basically represents the average daily range a stock can move in a day. So let's say a stock XYZ has a 5% ADR. That means in a day, the stock will move 5%, whether it's upside or downside on average in a day. And let's say we get a breakout and it surpasses 5% to the upside, we can say, okay, there's really some momentum gaining in this thing. It broke above today's average daily range. It's breaking out of these key levels. A lot of buying volume is coming in. And overall, that's what you want to look for when it comes to validating a breakout. And then as far as the setup, going back to pre-breakout, you want volume to taper off. After a stock makes a big move and starts to pull back, you want to see it taper off as price action gets tighter and tighter. Think of price action and volume acting like a coil. So again, like I talked about, if we go back here, we can see, stock made a big move, pulled back to the 10 SMA, and it gets tighter. It acts like a coil, tighter, 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 and then we want to see volume staircasing. So obviously I'm still on SPY, but we can see like, let me pull up an example for you guys. So a good one would be, my watch list isn't too good right now, but all right, ignore these weird drawings right here. So basically, this is what we want to look for. Stocks make a big move, pulls back to the 10, 20 SMA, creates these higher lows, you get the lower highs, and then we see volume taper off. Volume is tapering off, and then we can see breakout day. The reason why this failed today is most likely because the volume wasn't strong enough. I mean, we can see it is above average, but I was watching this morning, and at the time of breakout, the volume wasn't strong enough, and that led to sellers just cutting this thing off really quickly and leaving us with a false breakout. Is this invalidated now? No, it's not, but earnings are coming up soon, and like I talked about previously, I never hold into any crazy news, earnings, catalyst, anything like that. Let's say we hold this and then, or we sell it, and then after earnings, it gaps up, then we could play this as an EP essentially. But going back, so yeah, you want volume to taper off and then just kind of die out. Again, volatility contracts, we see it die down, gets tighter and tighter and tighter, and then on the day of breakout, we see volume kind of have like a burst essentially. And then number 4, this is literally, I just said this, but just to repeat it, it is essential to have a high volume, or it's essential to have high volume when the breakout occurs. Buyers must be strong or the move will fade quickly. Successful breakouts are most accompanied by a catalyst. So during poor market conditions, if you really want to trade, base all of your trades off of catalysts. So make sure they're all catalyst-based breakouts. But let's say, you're in bullish conditions, you're trading a leading stock, there's no catalyst on it necessarily. It breaks out, it can still sustain and make money 100%. But in terms like that, catalyst can be kind of the icing on the cake and act as the fuel for the actual stock to keep going higher, essentially. So again, catalyst, a piece of news or data that can drive the stock price higher. Cool. So now we understand market conditions are good. We gauge them. We understand the setup that we look for. How do we find these stocks? So personally, I use Thinkorswim. So I have a 1, 3, and 6 month scanner coded in here. And these update for me every single day at 2 a.m. They pause, they scan for about an hour, and then re-upload, I think at like 3 or 4 a.m. And then in the morning, they're ready to go. And they do that every single day. Personally, I scan over the weekends. I scan Sunday or Saturday, depending on, how many setups there are, if it's an exciting week, if it's pretty dry. Really all depends. But the way to scan is you are basically going to just click on your scanner and you are literally just going to click through this. For me, it takes me roughly about an hour to 2 hours long to scan, depending on, if I'm only scanning on here, if I'm using FinViz or any other softwares that I use to scan for stocks. But overall, you literally just go through here and click, click, click until you find something with the specific setup that we look for is, again, those high type flags, any sort of consolidation after a big move. Again, you want volume to die out. You want at least a 5% ADR, and you want the SMAs to be surfing the price action. So for this, for example, looks like a decent setup, made a nice little move, breaking out of a pretty big base right here. Let's see. All right, instantly, no, it's not a liquid stock. Personally, I look for at least 800,000 to a million daily volume, just on average, and we can see this thing trades like 250 to like 150,000 shares, which tells me it's a piece of junk. It's a low ADR as well, so immediately, just to know, even though the setup, it looks good, like technically, the actual underlying condition is absolute garbage. So we're not going to touch it, not going to put it on our watch list, etc. We only want to trade the 5-star setups. There is no reason to trade a 3-star setup. 4s, okay, they're exceptional. If it's a really good stock, if it's a leading stock within a leading sector, shows a lot of strength, but maybe the SMAs aren't aligning or it's lower ADR, whatever. But if it is a stock like that where it's not liquid, that's like the biggest red flag. Never going to trade it. Unless, it's like a micro cap or a small cap and it has a catalyst and then it gains a ton of volume, sure. But those are riskier to plays, and 90% of the time, those are like biotechs, which I don't even swing trade. You would have to day trade those. So yeah, probably nothing on the scanners right now. Market is pretty dry. I already have kind of my watch list built, but on Sunday, I'm going to rescan. Obviously, we have one more day tomorrow for things to set up, and then we'll go from there. But overall, that's how you scan. You go through all of these and then find the setups with your criteria. You're going to put them in your watch list, whether it's your weekly watch list, daily watch list, whatever you want to call it, and then scan over the weekend, build it, set up a trade plan for Monday, and then Monday, just be there when market opens and then see where things are at pre-market. And if anything breaks out of, the flag, the key levels, the previous day's highs, Wix highs, you're going to go ahead and enter those and manage your risk. We only risk 1% per trade, by the way. So the way to calculate that is actually by taking, 0.01, I don't have my paper in front of me, but it's going to be 0.01 multiplied by the dollar amount of capital you have. So let's say you have a $10,000 account. You want to risk 1%. So that's going to be 0.01 times 10,000. That means you can risk $100 per trade. So now, okay, how many shares do you buy per se? Let's say Johnny buys a stock XYZ at $5. Low of day when he buys at $5 is, let's say, $4.50. So that means there is a 50-cent difference between the entry and stop loss. So what you're going to do is you're going to take 100. I can't do simple math because I barely graduated high school. So you are going to take 100 divided by 0.5 because it's 50 cents. And that means Johnny should buy 200 shares of the stock. And let's say he bought 200 shares at $5 a share. He's going to spend $1,000. So he has $1,000 of equity into the trade. If he gets stopped out, he is only going to lose $100 out of his $10,000 account, meaning he only risked 1%. And by doing this, we keep our losers very, very, very small because the win rate on this strategy is pretty low because again, we are focused on an extremely tight risk to reward, so it's very easy to get stopped out. But one winner will absolutely blow these out of the water as long as you actually know how to hold your winners. The strategy, the number one reason people become unprofitable or can't become profitable with this is because of two things. It's managing risk and position sizing. The thing is, they cut winners way too early. Even after holding for 2 to 3 days, if there's still a lot of juice left, they'll cut them early. And let's say they catch a lot of losers as well. You can't let those winners ride out when your losers, you have so many losers, that potential winner you cut early, so you're not getting that full win to loss ratio per se. I mean, you can still be profitable by not maxing out how long you hold a setup, but definitely does cut down on some gains a little bit. So whatever you do, follow your rules. Cool. So that clears that up. So then leading sectors, this is something as you kind of dive deeper into like the actual stocks themselves, they are very important, and I do have scanners for them. But the thing is, when you guys look at the flags, the flag, the pennant, the wedge, whatever the heck you want to call it, that is not the reason the stock moves up. A lot of you are brainwashed into thinking these chart patterns, whatever it may be, the double top, butt, bottom, bro, whatever you want to call it, those patterns are not the reason the stock goes up. The stock is going up because it has an underlying condition already. The stock is already bound to go up. That that setup, that pattern is just accumulation happening. And our goal is to catch the stock when it's in that accumulation phase. And that flag, that wedge pennant, those are going to be our best entry points and give us the best risk to reward. Because again, we're looking at things from an investor standpoint. We want to get those growth stocks. We want to get those stocks with momentum. And then we want to just snipe our entries and then hold them for as long as possible. So the flags only give us our entry. All the other confluences just give us the confirmation to take them. And leading stocks within leading sectors is going to be the actual strength of a stock. We don't want to trade weak stocks. We don't want to trade stocks that are going down. We want to just follow trends, trade momentum, and ride it out for as long as we can. So again, leading stocks and leading sectors, very important. Personally, I use the iShares BlackRock. You can literally just filter out your I have I think it's 11 or 12 sectors. I could sound like an idiot, but 11 or 12 sectors. And then I have them filtered out by the biggest percent gain change in the past 20 days and 50 days. And then from there, I look and see, what's up the most. And then I just give myself my bias from there. So let's see right now. Right now, in the past 20 days, consumer staples, real estate, and utilities. Obviously, I'm going to do some deeper research. I could be wrong right now, but those are going to be the top 3 sectors that are leading just based off of price action right now. And then from there, I'd keep those in my head. And then as I scan, when I find a setup and put it in my watch list, I would find it, okay, this is a good setup. Awesome. Matches all my criteria. Is it in a leading sector? Hit over to analyze fundamentals. It'll tell you exactly where it's at right here. And that'll give you your confirmation if you're looking at a stock within a leading sector. You could dive a lot deeper and get into actual just like, industry scans, like literally just break down every single stock in the stock market. You can filter it by volume, etc., and stuff like that. Mine are obviously pretty dumbed down, but I basically find everything I want to from kind of these like brief scanners essentially. So leading stocks and leading sectors, very good. Use them, master them, very important. Last but not least, just the entry and exit realistically. So let's say number 1, you gauge market conditions, everything looked good. You know when you should have the green or red light to trade. It all looks good to you. Awesome. Cool. Green light, you go ahead, scan 1, 3, 6 month. You grinded for 2 hours, found the best stocks in the stock market you could ever see. Put them in your watch list. Awesome. They're in your watch list. They're in your watch list. You're waiting. Monday morning, boom, market opens. You take them. How do I take them? How do I know? 2 ways to go about this. This one is going to be the most common and probably the best for like beginner traders because it just really sets out the rules for you and leaves you with like no slack, I guess. No slack for you to kind of do your own thing. It's just still following. Entry strategy. There are 2 ways you can go about entering a breakout. Both are valid and can be used anytime there is a breakout. I'm just going to state them here. 1 is opening range highs. 2 is just a break of a key level. When I first started breakout trading, I did follow opening range highs because, again, it gave me a set of rules and a plan to follow because I wasn't solidified in my own decisions or in my own discernment yet. So I did a lot of opening range highs. Now I have some pretty good discernment when it comes to entering stocks in the market, and I just base everything off of key levels. I don't care as much as the best R to R possible so that I make the most money. I just care more for getting the best confirmation, and that's kind of how my bias switched, and yours will as well. But in the beginning, I think it's best to just follow an exact plan so that you build that intuition, you build that discernment over time, and then you can start getting into, just kind of playing around with things, entering at key levels, and then still just kind of, obviously stop loss still goes at low of day, but managing risk, position sizing, you kind of just get a feel for it and you kind of know what to do. But going over it, so opening range highs. When the first 5-minute candle is formed, we wait for the second 5-minute candle to take out the highs of the opening candle. The crossing point between the two will be our entry, and stop loss will be the low of the opening candle. So let me just go to 2 random 5-minute candles and show you exactly what this means. Okay, perfect. Ignore this red candle right here. Let's say market opens right here. Awesome. This is definitely not market open, but market opens right here. Cool. This is the first 5-minute candle. Let's say breakout was right here. Oh, yay. Broke out. Awesome. This is the first 5-minute candle. Next 5-minute candle forms. It took out the high of the first one. That's our entry. Entry, boom, right here. The second it takes out this high, so first 5-minute candle, next one spawns in. Let's go. Took out the high. Enter right here. But where does stop loss go? Low of day. Immediately, you can't change stop loss. Stop loss goes at low of day. And I always put my stop loss 1 or 2 cents below low of day because you never know. You never know. It could be a very, very strong support level and it could touch it and you could get stopped out. But if you left it 1 cent below, you could have just missed your stop loss and it could reverse and make you a lot of money. It's happened to me many times. So always put your stop loss 1 or 2 cents below low of day. So this is going to be the distance. So entry, let's say our entry, I'm not using that number. That's too complicated for me. Let's say our entry again, Johnny, his entry is at $5 right here. And the stop loss is at $4.50. There is a 50-cent difference between entry and low of day right here. So again, how much are we risking? 1% of our account is $100 because we have a 10K account. So you're going to take $100 divided by 0.5 because this is the difference. And you're going to buy 200 shares. So you buy 200 shares right here. And then no matter what, if you get stopped out, you're only going to lose $100 because you position sized correctly. And let's say you don't get stopped out, you make a ton of money. And that's how that works. So yeah, that's how you manage risk. That's how you take opening range highs. Let me hop back over to a cleaner chart. Wow, that is a nice flag, man. Okay, and then the second way is just a break of a key level. After a stock breaks out, we can use support and resistance levels to see key levels and can slightly pop above blank, blank, blank. This method is my favorite. Stop loss is still low of day, like I said, regardless. So, I mean, let me just stop reading off a paper for a sec and just go here. So, for example, like Clove broke out today. I didn't take this. I was really close to, but volume wasn't subpar up to par at the time of breakout. But realistically, instead of taking opening range highs on this, I would just enter once it took out the previous day's high. Took out the previous day high, broke out of the flag right here clearly. You would just enter off this key level and then stop loss can just go a low of day. It's a lot simpler for me. I already like when you get used to trading your account and as your account size grows, you just get such a good intuition for how many shares you can buy to manage your risk. So it's like really easy. Like if it's $1 stop loss, it's okay. I buy X shares. If it's $1.50, I just, add half to that or subtract half. If it's a $2, subtract whatever. You get a feel for it and overall you can do it. People ask me, it's like, okay, well, do I have to manage risk down to the penny? Do I have to buy shares down to the exact share? Realistically, no. I would just say keep it within a 5 share like range. Like if let's say it tells you to buy 86 shares, bro, buy 90. If it tells you to buy 96 shares, 94 shares, buy 90. If it tells you to buy 96, buy 100. I kind of just round things up. It's not going to matter if you risk 1.02% instead of 1%. You're not going to die. You're not going to become unprofitable. It's just, especially when there's a lot of stuff happening at once in the morning, it can be hard to manage risk, especially if you're kind of new to it. So again, doesn't really necessarily have to be, squeezing your nuts trying to manage down to the penny. Just overall have an idea of what your risk management is and go from there. Cool. That's how you enter the stock. So, okay, recap. Before our last recap, you gauge market conditions. Everything looks good. Awesome. Give yourself the green light. Cool. Go over to the scanners, find everything with your setup on it. Found all my setups, really solid ones, put them in my watch list. After I put them in my watch list, let me look at the leading sectors, see what's popping. Look at the leading sectors. Do any of my setups match these? Yes, a few of them do, a few of them don't. Let's say the few that don't are like 2-star setups, 3-star setups. You thought you'd throw them in there anyway. Take them out. You don't need them. If they're 4 or 5-star setups, but not in a leading sector, leave them. You never know what happens. Leave them in there. Cool. Watch list built, trade plan is built, you have your plan, Monday morning market opens. Awesome. You enter, boom, enter, you manage risk. Some days you might get stopped out, some days you may be winning. Let's say on the day you win, you're in profit, day ends, awesome. You're chilling, bro. You can sleep like a baby, don't have to sleep with one eye open or squeezing your nuts. That comes to the last part, sell rules. After the break, oh my gosh, I can't even read this. After the breakout occurs and sustains for the day, we rate 3 to 5 days to trim a third, fourth, or even half of our position, depending on how price action is developing. So this is the part that gets a little bit iffy because it does take some discernment and it does take understanding of price action. You can't fully base this every single time on, 3 to 5 days and then trim whatever, because there'll be some times where it's like, okay, 2 days after the breakout, and then there's some insane catalyst, or if it's like earnings or something, like you're not going to hold through that. You're going to have to cut the position. So this is the rule that's a little bit iffy. And this is, one of the most important things is just execution. So for me, it really all depends. When I trade shares, I don't mind holding for longer. There's no theta. There's no other moving parts. When it comes to options, I don't like swinging more than like a week. Like a week, 2 weeks even, it's just a little bit to me. I already buy contracts like a month out anyway, but realistically, if I'm trading options, I don't plan on swinging for more than like 3 to 4 days. You catch the burst of momentum, you make your money, you sell your contracts, you are out. Shares, you can hold a lot longer. But again, 3 to 5 days after the breakout occurs, trim a third, half, or a fourth of your position, depending on how price action is developing. So again, you have to have that intuition and kind of read where market is or the stock is at the time being. And then after doing so, you set our stop loss to break even. So the second you trim, throw your stop loss to break even, you are golden, my friend. This is the euphoria stage. You made money, stop losses break even, you could care less. Everything is good. Everything is rainbows and sunshine. Yeah, so stop loss goes at break even, and then we're going to use the 10 SMA or EMA. Personally, again, I use SMAs to trail the rest of the position. So that means, let's say you trim half of your position, you have 50% of your position left. Stop loss is low of day. No matter what, you're not going to lose any of the profits you secured, just whatever your position is worth right now. And let's say it trails above the 10 SMA for, a few more days. You can trim another 10% after a few days, another 10% the next day. And then I like to leave at least 15 to 20% of my position, sometimes even 10%. That's when you're just going to trail and you're not going to do anything. You can leave a trailing stop with it if you want. But personally, you can just leave it at break even and you're just going to hold that remainder of the position, whether it's 10, 20, 30%, as long as it rides above the 10 SMA. And then the day that it closes below the 10 SMA, you cut the rest of the position. And that is going to be the end of the swing trade. Strategy, there's not a whole lot that really goes into it. It's not the most complicated thing on earth. It's not super hard to master. The strategy itself is pretty simple. It's really just a matter of being able to manage your risk, understanding sector rotation, leading stocks and leading sectors, and then just kind of getting that pattern recognition of the flags that we look for and knowing when flags work and when they don't. But nonetheless, I really hope this kind of raw style video helped you guys. I hope you guys enjoyed. And yeah, if you guys want to become a part of the community, I think it's dropping pretty soon from the time of this video. Feel free to shoot me a DM on IG and kind of get in line for it. I'm really excited to drop it. It's going to have basically all this education broken down into PDFs. That PDF that I just showed you guys here is actually in there as well. If you guys want to go over that, as well as all my alerts, 3 live trading / group calls a week, bunch of other stuff. I have another analyst in there who I've been, pretty good boys with, and he's a smart dude. So you guys can definitely learn a lot from the both of us. And yeah, just absolutely print with us and swing trading breakouts. And then again, if you guys want to be a part of my one-on-one mentorship, I opened up, I think I have 2 spots left in February, but it's coming to an end. So beginning of March, we're going to open up a few more spots. And if you guys want to be coached by me personally and become profitable in literally as little as 30, 60, or even 90 days, feel free to shoot me a DM on IG and we'll see if you're qualified. But nonetheless, hope you guys enjoyed the video and I will see you in the next one. Peace.